Imagine spending like 40 years building a multi-million rand business. You survive market crashes, you work 80-hour
Oh,
weeks.
pouring absolutely everything into the company.
Exactly. You pour everything in, and then suddenly you lose your family home, your investments, your entire life savings, all because of one bad contract you signed 3 years ago.
It sounds extreme, but it's the reality for thousands of entrepreneurs. I mean, it really is.
It's terrifying. So, welcome to today's deep dive into the architecture of wealth protection. Our mission today is to show you why separating your business risk from your personal assets is, well, it's the ultimate business cheat code.
It really is. It's probably the most dangerous blind spot in business right now.
Right. And to break this all down, we're drawing on a really comprehensive South African donations tax guide. Plus, we're pairing those pretty complex tax codes with the real-world strategic framework of trust consultant Limke Sturman,
Yeah, we're looking directly at the philosophy she applies in her own practice.
which you can actually check out at www.lumkosterman.com. So if you're out there running a business, consulting, taking any kind of professional risk in your own name right now, you are carrying this massive invisible burden.
A huge burden. And you
It-
probably don't even realize it.
Exactly. So we're going to show you how to build a fortress around your wealth.
But, to understand the fortress, I think we first have to examine the trap.
Let's do it.
So let's look at the default setting for almost everyone. You start a company, right?
Yeah.
It does well. You buy a house, maybe a couple of cars, an investment property.
And you just put them all in your personal name because, that's just what people do.
Exactly. But your trading company, the actual entity that's out there, signing leases, hiring employees, dealing with suppliers, that entity is inherently risky.
And this is where that whole idea of the corporate veil just completely fails you.
Oh, 100%.
Because think about it. You go to a bank to get a credit facility to grow the business. The bank looks at your company and says, sure, but we need you, the director, to sign personal surety. Right? They want you on the hook.
And you sign it because you need the cash flow. But you've just unknowingly connected this massive pipe between your risky business and your safe family home.
And the mechanism of personal surety is just ruthless. If your business faces a big lawsuit or a sudden liquidation, the creditors don't just stop at the empty shell of your company.
We keep going.
They keep going. That surety agreement lets the liquidator look directly at your personal balance sheet. They see the house, they see the savings, and they come for all of it.
Just to satisfy the business's debt.
Wow.
So the way I like to think about it, it's like operating a casino.
Oh, I like that.
Yeah, you want the casino floor, which is your business,
Yeah.
to be where all the risk happens, where the bets are placed, the action is happening.
Yeah.
But you want the vault holding your gold in a completely different building.
Right. Protected by entirely different guards.
Exactly. And this is the core of the asset protection fortress philosophy that we see in Limke Sturman's framework. The brilliance is just the separation. Your company carries the risk, your trust owns the assets, and that structural divide changes absolutely everything. When the gold is sitting in that fortified, legally distinct vault, a business creditor just cannot touch it.
Because it's not yours anymore.
Exactly. You are functionally reducing your personal liability to zero for those specific assets, while, your business just continues to generate income on the casino floor.
And I imagine it also locks in generational wealth, right?
Oh, definitely. If the unexpected happens to you, your family isn't scrambling through probate court. The wealth is already secured in a structure designed to outlive you.
Okay, I love the idea of this vault. But let's look at how it's actually built, because I have a major conceptual hurdle here.
Sure, let's hear it.
If I take my 5 million rand family home and transfer it into a trust, legally, I don't own it anymore, right? The trustees do.
That is correct.
And in South Africa, I'm legally required to appoint an independent trustee to a family trust. So what is stopping this complete stranger from outvoting me, selling my house, and just running off with the money?
Right. The loss of control fear. It's literally the first question every single person asks when they start looking into trusts.
Because I don't want to just give away control of my own life.
Of course not. But to understand why you're safe, we have to look at how a trust is actually governed. A trust isn't a person. It's a legal relationship.
Okay.
You, as the founder, create a trust deed. Think of the trust deed as the constitution of your vault. You write the rules before you ever put a single rand inside.
So I dictate exactly how assets can be sold, who benefits, things like that.
Exactly. You set all the conditions.
So I'm basically writing the instruction manual for the guards, and this independent trustee has to follow it.
They are legally bound by fiduciary duty to follow it. The independent trustee isn't there to steal your house. I mean, they're really there as a compliance mechanism.
A compliance mechanism for who? SARS?
SARS and the courts. They want to see that this vault is a genuine, separate, legal entity. If you just treat the trust bank account like your personal wallet,
Like buying my weekly groceries from it.
right, just ignoring the other trustees. If you do that, SARS will look at it and declare it a sham trust.
Ah. And if it's a sham trust, the fortress walls vanish. And the creditors can just take the assets anyway.
Precisely. Which is why the independent trustee is so crucial.
Yeah.
They provide this objective paper trail that proves decisions are being made jointly, formally, and in the best interest of the trust, not just serving as your personal alter ego.
So control isn't really lost, it's just redefined from direct ownership to, like, strategic management.
That's a perfect way to put it.
Okay, that makes a lot of sense. The fortress is secure, so I am ready to move my 5 million rand house into this vault, but I'm guessing I can't just slide the title deed across the table for free.
Definitely not. The government is always watching that movement. And this brings us to the hidden trapdoor in South African law donations tax.
Right, because SARS is well aware of this asset protection game.
Oh, they know exactly what people are trying to do. If you gratuitously dispose of property, which just means giving away an asset without getting its full market value in return, you trigger a tax event.
And the rate is pretty steep, isn't it?
It is. It's a flat 20% on the cumulative value of your donations, up to 30 million rand over your lifetime.
And after 30 million.
Anything beyond that jumps to 25%.
Wow. But the most counterintuitive part of this whole law, to me at least, is who actually gets the bill.
Yep. The donor pays the tax, not the recipient.
Which is wild. If I give you 1 million rand, you get to keep the entire million. But I have to dig into my own pockets to find an extra 200,000 rand to pay SARS.
It feels backwards, right? But we have to ask why SARS designed it this way. What's the underlying logic?
I'm guessing they aren't just doing it to be mean.
No, well, donations tax exists primarily to defend another tax, estate duty.
Ah, the death tax.
Exactly. When you pass away, your estate is taxed at 20%. If donations tax didn't exist, every wealthy person in the country would just transfer all their assets to their kids on their deathbed.
And totally bypass estate duty. That makes sense.
It also stops income splitting. You know, where you give an income-generating asset to a family member in a lower tax bracket just to cheat the progressive tax system.
So SARS harmonized the taxes. You pay 20% whether you give it away now or pass it on when you die. They get their cut either way.
Exactly.
But the danger here isn't usually just outright gifts, right? The real bloodbath seems to happen with what the tax code calls a deemed donation.
Oh, deemed donations are where people get completely wiped out.
Let's walk through a real-world hypothetical to see how catastrophic this can actually be. Let's imagine a guy named John.
Okay, let's look at John.
John has a commercial farm worth 10 million rand. He learns about the asset protection fortress, and he wants his farm in a trust. But he doesn't want to pay the 20% donations tax. So John thinks he's a genius. He drafts a sale agreement, and he sells the 10 million rand farm to his family trust for 1 single rand.
Oh, no. John has just stepped on a massive legal landmine.
Because SARS monitors the deeds office.
They do. When they see a property valued at 10 million rand transferred for 1 rand, they do not view it as a clever sale. The law clearly states that the difference between the market value and the actual consideration paid is a deemed donation.
So SARS looks at John and says, you didn't sell a farm. You donated 9,999,999 rand in value.
And then they just hand John a tax bill for 20% of that value. So John now owes SARS roughly 2 million rand in liquid cash, payable immediately.
Which John does not have.
Oh.
Because all his wealth is tied up in the farm he just transferred.
Exactly.
So what does he do? Does he literally have to borrow 2 million rand at some punishing interest rate, or, I don't know, force the trust to liquidate the exact farm he was trying to protect just to pay the tax man?
Pretty much. He bankrupts himself trying to be clever. It illustrates perfectly why you just cannot manipulate market value. Every asset moved into a trust has to be defensively valued.
That is horrifying. Now, historically, business owners saw this 20% trapdoor, and they actually found a pretty brilliant workaround, right?
They did. They realized they couldn't give the asset away, and they couldn't fake a sale. So they decided to just lend the money.
Right. So John would sell the farm to the trust for 10 million rand, but the trust doesn't have the cash. So John just issues a 10 million rand loan to the trust.
And because John controls the terms of the loan, he charges the trust 0% interest.
It was the ultimate loophole. The trust gets the farm, John holds a loan account, no donation actually took place, and the asset just grows in value inside the vault, completely tax-free.
It was the standard operating procedure for decades. I mean, SARS was watching billionaires living lavishly out of trusts that were funded entirely by interest-free loans.
The wealth was compounding in the trust, and SARS was getting absolutely nothing.
Exactly. So in 2017, they brought the hammer down. They introduced Section 7C to aggressively close that loophole.
Let's break down the mechanics of Section 7C, because this is a silent killer if you have an old trust.
It really is.
Yeah.
SARS decided to use the official rate of interest, which hovers around 8%, as their benchmark. They basically decided that 8% is what a normal arm's-length commercial loan should cost.
Okay, so how does that affect the 0% loan?
The mechanism works like this. If you lend 10 million rand to your trust at 0%, SARS calculates what you should have charged. 8% of 10 million is 800,000 rand.
Right.
So SARS says that by not charging that interest, you are effectively donating 800,000 rand of value to the trust every single year.
Which means that 800,000 rand is a deemed donation, and you now owe 20% tax on it.
Yep. John has to pay SARS 160,000 rand out of pocket every single year that the loan exists. It's a constant annual financial bleed.
That's brutal. So what's the alternative?
Your alternative is to actually charge the trust the 8% interest to avoid Section 7C entirely. But let's follow that logic.
Yeah.
The trust now legally owes you 800,000 rand in interest payments every year.
Right.
When the trust pays you, that money enters your personal bank account as taxable income.
And depending on your personal tax bracket, you are paying up to 45% income tax on that interest. So SARS essentially built a toll booth on the only road leading to the trust.
That's a great way to look at it.
You either pay the upfront toll in donations tax, or you sign up for a mandatory, highly taxed monthly subscription fee through interest payments. They made sure they get paid either way.
They absolutely did. It forces a strategic choice based on your cash flow and time horizon. But, it's not impossible to navigate. Savvy investors use specific, entirely legal mechanisms to move wealth without bleeding cash at the toll booth.
Okay, let's explore those workarounds because people need to know how to do this legally. The most common tool seems to be the annual exemption.
Yes. Every natural person in South Africa gets to donate up to 100,000 rand per tax year, completely free of donations tax.
It seems small when we're discussing multi-million rand businesses, though.
It does, but consider the slow drip strategy. If you're married, spouses are treated as separate individuals for this exemption, meaning together you have 200,000 rand a year.
Ah, okay.
So you can systematically donate 200,000 rand worth of company shares to your trust every single year. Over 10 years, you've moved 2 million rand in equity into your fortress, entirely tax-free.
Wow, so it's a game of patience, but structurally it's totally sound.
Exactly.
And speaking of spouses, the law actually treats spouses as a single economic unit when it comes to donations, right?
It does. You can transfer unlimited assets to your legal spouse without triggering a single cent of donations tax.
That's a huge workaround. So if I have a high-risk tech startup in my name and my spouse is, say, a salary teacher with zero business risk, transferring the family home into their name is just an immediate tax-free layer of protection.
Spot on. Another highly effective mechanism for larger assets is vendor financing. This is brilliant for business succession.
How does that work?
Imagine you want to pass a 50 million rand manufacturing company to a trust for your kids. You sell the company to the trust at full market value, 50 million rand. Because it's a fair market sale, there's no donation.
But wait, the trust doesn't have 50 million rand in cash to pay you.
Right. So you finance the sale yourself. The trust owes you a 50 million rand loan. Now, the company continues to operate and generate profit. It declares dividends to its new shareholder, which is the trust.
Okay.
The trust then takes those dividends and uses them to slowly pay back the loan to you.
Oh, that's smart. You're extracting the value of your company over time at market rates, while the capital growth of the company is locked safely inside the trust.
That is architectural brilliance right there. And you also have the strategy of just donating early.
Right, catching it before it grows.
Exactly. If you start a company today, the shares are mathematically worth almost nothing. So you issue the shares directly to the trust on day one. You pay donations tax on a negligible amount.
And then 5 years later, when the company is worth 50 million rand, all that explosive growth happened inside the vault. You tax the seed, not the tree.
I love that. Tax the seed, not the tree. But we really need to look at the other side of the equation. Once the wealth is actually inside the vault, the tax environment changes drastically.
So.
Trusts in South Africa don't get the progressive tax brackets that individuals do. A trust pays a flat 45% income tax rate from the very first rand it earns,
Thanks.
and the effective capital gains tax rate is 36%, compared to a maximum of 18% for an individual.
Wait, if the tax rates inside the trust are that brutal, why would anyone ever use one? You're essentially volunteering to pay the absolute maximum tax possible.
Well, that's the intentional friction SARs built into the system. They apply the maximum individual rate to trusts specifically so you can't use them to hide income in a lower tax bracket.
Uh,
The punitive rates reinforce the core philosophy. Trusts are not designed to save you income tax. They are designed for extreme asset protection and estate planning. You use a trust to protect the capital, not to day trade stocks for a quick profit.
This level of complexity really explains why setting this up is absolutely not DIY territory. I mean, you get the valuation wrong, you trigger a deemed donation,
Yeah.
you ignore an old loan account, you trip Section 7C.
And you're bleeding cash.
This is exactly where the framework provided by a trust consultant like Lumka Sturman becomes essential. Her approach isn't just about, filing some paperwork with the master of the high court. It's an architectural methodology.
Her focus is deeply analytical. In her practice, she uses what she calls an asset protection blueprint session to physically map out a client's risk.
That makes sense.
She looks at the personal balance sheet versus the business exposure. You can't build a fortress if you don't know where the arrows are going to come from. She structures the exact company trust combinations to ensure that the entity taking the risk is completely severed from the entity holding the wealth.
And what stands out from her methodology is the emphasis on education. She ensures that business owners actually understand the mechanics of their own trust.
Right, so you're not just flying blind.
Exactly. There's one-on-one coaching so that the founder remains in the driver's seat. You aren't just signing a dense legal document and hoping for the best. You are actively managing your wealth's architecture. It's about maintaining compliance with SARs so that when a crisis hits, the walls of the fortress actually hold up.
Because the cost of noncompliance is devastating. Paying a professional to map this out and conduct annual compliance reviews, it pays for itself the moment you avoid a single deemed donation trap or a Section 7C penalty.
Completely. Protecting your wealth with a trust is the smartest move a business owner can make, provided you actually respect the mechanics of the law.
It's the ultimate cheat code, but only if you play by the rules.
Exactly. And you can explore this entire framework and book a consultation through her website at www.lumcasterman.com. It's seriously worth checking out if you're holding any kind of business risk right now.
Absolutely.
But before we wrap up this deep dive, I want to leave you with a final thought to ponder. Throughout all the tax codes we explored today, the word property is defined incredibly broadly. It's anything with economic value, tangible or intangible.
That's a good point.
As we move rapidly into a purely digital economy, what happens to your lucrative digital footprint? What about your crypto asset portfolios, or highly monetized personal brands, or massive social media accounts generating revenue?
Oh, wow. Yeah, the virtual assets.
Right. If a physical family home requires this much strategic, complex trust planning to transfer safely, imagine the unprecedented legal chaos our children will face trying to inherit entirely virtual empires across international borders.
It's going to be a nightmare.
It really is. Have you thought about where your digital legacy fits into your physical fortress? Think about that. We will see you on the next deep dive.